Countries like China, Saudi Arabia, and Japan stockpile US dollars. Not as physical cash, but by purchasing US Treasury bonds. These bonds help hedge against inflation while preserving the utility of dollar holdings. Why not just hold the cash? Because the US dollar, while powerful, loses purchasing power over time. In fact, it's depreciated by about 30% over the last 20 years, largely due to continual monetary expansion by the Federal Reserve. If you hold only cash, your wealth erodes quietly but steadily. Treasury bonds, by contrast, pay interest, which helps offset that loss. This is exactly why countries like China, which earns billions through trade with the US, plow much of that income right back into American bonds. It's not just about yield, it's also a strategy to avoid the appreciation of their own currency, which would hurt exports. Currency appreciation can be devastating for export-driven economies. Take China, for example. If it were to hoard US dollars without reinvesting them, the value of the Chinese yuan would soar. It sounds good at first, until you consider the impact on exports. Suddenly, Chinese products would become significantly more expensive on the global market. A pair of sneakers that once cost $100 might now sell for $150. Global buyers would turn away, factories would shut down, jobs would vanish. The economy could spiral into crisis. It's a scenario China wants to avoid, and one Japan knows all too well. During the 1980s, Japan earned enormous sums of US dollars by exporting cars, electronics, and appliances. In response, US policymakers pushed Japan into signing the Plaza Accord, an agreement that forced the yen to appreciate, nearly doubling its value from 240 to 120 yen per dollar. The impact was immediate and brutal. Japanese exports became dramatically more expensive. Demand dropped, factories closed. And powerhouse brands, like Toyota and Sony, began relocating operations to China. Japan's once booming economy entered a period of prolonged stagnation that would last for 3 decades. The lesson was clear. When a nation accumulates too many US dollars but fails to reinvest them, its own currency strengthens, pricing its goods out of global markets and triggering economic decline.